Well, the US market has amazed everyone with its ability and its resilience to keep rallying. I think the fundamental premise is that the US equity market versus the valuation of the bond market shows equities are still a long way from being expensive. On historical PEs, the US market is, again, a long way from being classed as an expensive asset class. And I think the extent of under-ownership by mutual funds and professional managers of that US stock market, too many doubting Thomases, if you will, mean that I think the line of least resistance for US equity prices is up, not down. We've just been through a challenging year or two of earnings contraction in the United States. This year we should see 10 or 11% earnings per share growth for US corporates. So I think the outlook for the US stock market is strong, and I think that is a great underwriter for the performance of the Australian share market over 2017. Fund managers need to be across the micro and the detail of businesses and sectors and what's happening in their specific backyard or their area of expertise, and we do the same thing. We've always found through years of investing that you need to have the backdrop set about right. What are the big macro drivers that are going to influence allocation decisions, that are going to influence the performance of certain sectors within your portfolio? It'd be unusual for bond proxy style stocks to be rallying globally but not in Australia. It would be odd for commodity names to be performing in the London share market but not happening here. So you need to build a picture that incorporates your top-down macro views as a driver, as much as you need to be owning stocks that have micro or company-specific appeal. The best gold stock in the world, who's well managed with great production profiling and great exploration upside, is not going to go up when the gold price is under selling pressure and destined to trade lower, possibly to new lows. It's one of those things where our style is you cannot divorce top down from bottom up for too long. You need to have the two in sync. I mean, we were reasonably early with our embracing of cyclical stocks and the whole pro-resource rally that started February last year. That was on display for all to see in the United States share market and quickly transmitted into interest in Australian cyclicals. That's a great example of a sectoral change where expensive defensives and bond proxies, as they were colloquially referred, performed for 2 or 3 years into about February of last year, where there was basically a seismic event. Things changed. Resource stocks started performing, gold stocks started rallying, and the market took on an appetite for cyclical stocks. The pressure was building that, in fact, bond rates would start to back up. The interest rates had completed, certainly by July, had completed their low point, historic lows in the 10-year bond. That quickly brings about the reinforcement of the argument that cyclicals are back on, okay, and that PE contraction will start, that the expensive defensives now become funding sources for some of the cyclicals. And have a look what's happened in the States with bank stocks. Same thing has happened to our bank stocks. In their own way, bank stocks themselves are cyclical businesses. They rely upon consumer sentiment, they rely upon animal spirits being supportive. So I think the cyclical turn, which caught everyone unawares, there were cyclical stocks in the Australian share market, such as the mining services names, and we all know what those businesses look like and trade like. They were essentially dormant from 2012, May, June 2012, till about May, June 2017. It's a 5-year hiatus. So there's a time when these stocks come into vogue, they come back into ownership, and or they vie for ownership. And I think we've just been through one of those sort of events where there's been a rotation that's occurred.